Hey guys, what is going on? Welcome back to my Robinhood portfolio. As always, hope you guys are having an awesome, relaxing weekend. What I thought I'd do today is talk a bit more about dividends. This time, talking about high income or high dividend yielding stocks. A lot of you guys have been asking why I'm bothering with blue chip stocks that are paying 3 to 5%, and are wondering why I simply don't put my money into stocks that pay 10 or 15%. Very ultra high income, high dividend yielding stocks. Some have suggested I, for example, put in $80,000 into 15% stocks, make $1,000 a month on dividends, and I can either reinvest that or live off those dividend payments. And I'll just say very quickly, I think that would be terrible investment advice. If anybody's been telling you that, I would not at all follow that advice. It's actually, quite dangerous with regards to long-term investment. There's a number of reasons why that is. So, first and foremost, high dividend income stocks are very risky. They're risky because of two different reasons. First and foremost, it's very difficult for a company to pay out that kind of dividend over the long term. So I have one of these companies up, a closed-end fund from Pimco High Income Fund. This stock, as you see on the bottom here, pays 12.919%. And initially, I had a little bit of the stock, but quickly got rid of it for the reasons I'm going to discuss. So it's got a very high dividend yield. It actually pays out 0.1035 per share per month, which is a very good dividend. But what you guys probably don't realize is that a lot of that dividend is simply return of capital. So this fund essentially tries to generate income through a number of different investment avenues, and at the end of each month, it takes the profit it makes and distributes back to the investor as a dividend. However, the company has not been able to give that dividend back as a profit. It actually has been going into its working capital and essentially distributing that back to the investor. So every month when it distributes that 1.1035 dividend, about 0.06 of that is actually return of capital. So it's essentially returning the investor's money to the investor. As you can imagine, if it does that for a long enough period of time, it's going to erode the share price of the stock, because the share price of a stock is essentially based on how valuable the company is. And if the company's paying back its working capital, every month that company's going to be worth less, and over time it's going to erode the price of the stock. And unless you look at the details of its financials, you wouldn't necessarily know that. And just overall, it's a huge burden on the company to try to get that dividend back each month to the investor. So what happens is a lot of these companies will cut that dividend, and if that were to happen, the share price of the stock would essentially tank. And you can see one of these events here for this Pimco High Income Fund. You can see here October 25th, it's 935, and just a few days later, it's 863. So you can see the dramatic price difference that a cut in a particular dividend would make. The other big problem with these stocks as well is they are at risk for what is called interest rate risk. So as interest rate rises, other investments become much more attractive to investors. Investors start pulling their money out of these types of high-risk funds, and the price will also tank as well. And as you guys know, 2017, there's already 3 interest rate hikes planned, and that may be accelerated as well, depending on how well the economy does, or at least what the inflation rate does, because essentially that's a way of the federal government, the forces that kind of oversee our financial markets, to keep inflation in check. So if the economy starts taking off, inflation takes over, and by increasing interest rate, you basically kind of put a halt on the economy and attenuate a lot of that inflation risk. So if that does happen, a lot of these investments are going to be less attractive to investors. Investors are going to start pulling their money out of these stocks, and as a result, the price will drop as well. So for both of those reasons, which are quite significant reasons, these funds are not good long-term plays. Yes, they're okay for maybe a year or two, but if you were to buy and hold this over the long term, I don't think you'd have a very good time. And you can see here, the stock has these huge wild swings in it. This is pretty characteristic for all these high-income stocks or high dividend yielding stocks. When I say high dividend yielding, I mean ultra high dividend, 10%, 15% stocks. High dividend stocks of 3 to 5%, I think, are awesome, excellent investment strategies or buy and hold strategy stocks. These stocks are not, because of these wild swings here. Yes, you could say over the 5 years it's gone up 41.78%, but really the market as a whole has gone up 120 to 130%. And a lot of these wild swings as well, this stock may never recover. The investors may never have confidence in the stock again. I chose this PIMCO High Income Fund because it's quite popular with investors. This is one of the more popular and stable. You can see there's pretty low volatility with regards to a long term. But there's a lot of these funds out there that don't have the sort of name recognition or investor loyalty that this one does. So they're very, very high risk. So hopefully you guys kind of followed all that, why I don't think these are very good investment strategies. Yes, for a short period of time while doing some day and swing trades or holding on to these while you're kind of figuring out other parts of your portfolio, they're fine. But for the long term, I would not put a lot of money into these, and I would not put most of your money into these. I own a few of these, but it's just part of my diversification. It's a small part of my portfolio. So I hope you guys don't think I hate these. I don't hate these, but I don't think these should be the primary position in your portfolio. I don't think you should have most of your money in these types of stocks. If you have some money in these stocks, that's completely fine. But if you're putting most or all of your money into these stocks, I think that's a very bad idea. And at some point, I think you will get burned. So that's the reasons why I don't like these stocks. I think this is the reason why. Yes, I have a few of these in my portfolio, but these will never be a predominant part of my portfolio. These will never dominate my portfolio because of how risky they are. So, yeah, let me know what you guys think of these ultra high dividend yielding stocks. If you guys own these, like I said, I own a few of these, but they're a very, very small part of my portfolio. Yeah, let me know what you guys think of these stocks, what your opinion is, if you like them or not, if you agree with my sentiments or you differ, and if you differ, tell me why. The whole point of this blog is to learn and to get different opinions about investment strategies and different ways of going about making money. So, yeah, kind of with that, I'll end the video. As always, if you enjoy my videos, feel free to like, share, and subscribe. Like I said, the whole point of this video is to learn, not only for myself, but for you guys as well. This is video, again, that has been suggested by some users, or at least from some user questions about why I'm not putting more money into these ultra high dividend yielding stocks. So yeah, kind of with that, I'll end the video, and we'll see you guys later.